Hi, everybody. Scott Roberts with Nichols Wealth Partners here to talk to you about Indexed Universal Life, or IUL. My experience has been that most people understand a little bit about how it works, but they don't truly understand how it works. So in this short video, I'm going to walk you through and explain. So let me share my screen here and kind of walk you through. So three main things that people tend to understand about IUL. The first is that the policy cash value is credited based on the performance of the chosen index or indexes. So maybe that's the S&P 500. However that performs, that credit goes to the policy. The second thing people understand is that the crediting rate is often capped when the index has a positive return, limiting the policy return to a specified percentage, such as 11%. And the last thing that people understand is that there's a floor, so usually 0%, so the policy can't actually have a negative return. In this example here, this chart, you'll see that this is the market going up each year. So for the first 2 years, we have positive returns. We credit the indexed universal life, but it's capped each year, but it keeps going up. Then when the market goes way down, we just get zero. So we stay where we are in the cash value. Then as the market tends to recover, we go up inside the index universal life from that period forward. So that's kind of how that works. But the understanding of IUL often stops there, and that's where people start making assumptions. For example, if this chart was the return of the S&P 500 over the past 16 years or so, most people are assuming that the insurance company is taking all the returns above the cap in exchange for the downside protection. That actually would be logical if indeed we were actually investing directly into the S&P 500, but we're not. So let me explain. But to do that, let's start with an example of assuming an S&P 500 index, an 11% cap, and a 0% floor, which is a pretty standard scenario. So if the S&P 500 had a negative return, well, the IUL credit, we would just get zero inside the policy. Let's say the S&P 500 had a 6% return during the period. Well, we would get that 6%. And if the S&P 500 had a 16% return, we would be capped at the cap of 11%. And so we would only credit inside the IUL the 11%. So the question is, how does all this happen? So let's take an example. And for every $1,000 of premium that goes into an insurance policy, the insurance company is taking an appropriate amount, let's say $950. By the way, this example sort of ignores cost of insurance and fees, just to make it a little bit more simplistic. But they take $950 and they invest it in the insurance company's general account, which is invested in conservative investments like bonds. And since they're an institutional investor, they can get returns like 5.3% on their investment grade bonds. Whereas if we tried to do that as individuals, we couldn't even come close to that. Well, they know then that at that 5.3%, after 1 year, the $950 grows back to $1,000. Well, they just created the floor. Then the question is, what about the other $50? So the other $50 becomes our options budget. And what we do with it is we buy 1 year call options, a call option being the right to buy a security at a specified price on an exchange traded fund, or ETF, that mirrors the S&P 500. And our call options that we buy have a strike price, that's the price that you can buy it at, equal to the current price. So if that were in our example here is going to be $100. So in general, if the S&P 500 goes up in value, our options go up in value as well. For example, if it goes up to 109, we can still buy at 100. So $9 in profit gets credited to the policy. Now, if the S&P 500 goes down, well, then our options just become worthless, aren't worth anything. But remember, our $950 grew back to $1,000. So we still have that floor. So we talked how we got the floor. We talked about how the crediting inside the policy is doing due to purchasing call options on an index. But what about the cap? That's the missing piece to the puzzle here. So the first thing to understand about the cap, why we have that, is just to understand the logic of a bigger options budget obviously means that we can buy more call options, which gives greater growth potential inside the insurance policy. So we also sell out of the money call options with a strike price equal to the cap. And we use those proceeds to buy yet more call options. So I have an example here to kind of walk you through it. So let's say the S&P 500 ETF current price, $100. We buy calls with a strike price equal to $100. We knew that. We also sell calls with a strike price at $111, which is 11% higher. We use that money to buy more calls with a strike price at 100. So we're going to pull all that together on one diagram here. We have our 0% floor, and we know we get that because we take $950 invested in the general account of the insurance company, and it grows back to $1,000 at the end of 1 year. We have the 11% cap because we sold call options with a strike price 11% higher than the current price. So let's take the example. We have our 16% return in the S&P 500. What happens? Well, the first 11%, our purchased call options increase in value, and that profit gets credited to the policy. Between 11 and 16%, the call options that we sold increase in value, but that profit goes to whoever bought those call options from us. So to summarize, we're not invested directly in the index. We get market returns through the value of purchased call options that have a strike price equal to the current price. We have a cap that's created by call options that we've sold with a strike price equal to the cap price. And the floor is maintained by conservative investments in the general account. So for those of you keeping track with your financial dictionaries at home, that indexing crediting method that we just talked about is called a bull call spread. Now, there's other types of indexes we can use, other types of crediting methods we could use. We just gave one example here, which is the most common one that you'll run into, where you have an S&P 500 index and a cap and floor index crediting strategy. So hopefully you found this information useful and helpful. Please feel free to call or email if you have any questions. And everybody have a great day.